You know, the market is just a constant fire hose of noise, isn't it? You got price alerts, headlines, social media, all of it screaming at you to either buy or sell. It feels like it's designed to make you feel like you're always one step behind, just reacting to chaos instead of actually anticipating the next move. But what if? What if there's a clear signal buried inside all that noise, a divergence that just demands our attention? Well, let's look at the data. And this right here, this captures that feeling perfectly, that whiplash. The market rips higher, you finally jump in, thinking you've caught it, and then bam, it reverses just enough to take you out. You get punished on the way in and on the way out. That isn't trading, that's just getting whipsawed by the noise. And honestly, it's exhausting. And this is the real cost of trading on emotion. Fear just completely takes over, you hit the panic button, you close the position, and then you have to sit there and watch in agony as it moves exactly where you thought it would, just minutes after you're out. That's not a strategy, that's just a gut reaction. And here you go. This is the end game of that whole cycle. A few early wins feel incredible, right? But if you don't have a process, you're just on a hot streak at the casino. And the market, it really doesn't care about your profits. Eventually, the house always wins. It's a painful lesson, for sure, but a necessary one. Okay, enough of the chaos. Let's just cut straight through it. We're going to turn the volume way down on all that emotion, and we're going to crank up the signal from the data. We're going to stop guessing and start tracking what the largest players on the field are actually truly doing with their capital. So the very first signal we're looking for is in the flow. Where are the big institutions, the quote-unquote smart money, placing their bets? See, they can't hide their size, and by tracking how they rotate between different sectors, we get a really clear map of where the market's conviction truly lies. Now, check this out. This is our first piece of hard data. For the week of November 10th, our money flow scans are showing that big capital is rotating into these specific sectors: materials, energy, financials. They're all moving into what we call leadership positions. Now, this isn't a prediction, this is a direct observation of where the money is flowing right now. So, how do we actually see this stuff? We use something called a relative rotation graph, or an RRG. The easiest way to think of it is like a momentum map. It shows us which sectors are heating up and moving into that improving quadrant, and which ones are already outperforming in the leading quadrant. It basically turns that fire hose of data into a simple, actionable picture. But, knowing where the money is going is really only half the battle. The other half, which is just as important, is understanding how the market is pricing risk. And this is where we go hunting for anomalies in volatility. Okay, this chart right here reveals a pretty critical market anomaly. We're looking at call premiums, and you can see that SLV is a massive outlier. The market is pricing in a huge expected move, which makes its options really expensive. Now, that's not a judgment, it's just an observation, and it's where we can find our edge.
So what exactly is call premium? Well, it's a simple ratio that compares implied volatility, that's what the market thinks is going to happen, to historical volatility, what has actually happened in the past. A high ratio, like that 1.04 we saw for SLV, it tells us that fear is high, and option sellers are charging a pretty hefty premium for it.
All right, now let's put it all together. The rotation and the volatility. How does an institutional desk use this data to build a high-probability trade? Let's break down a real-world case study. Here we've got a massive, highly unusual trade in ASHR. That's the China A-shares ETF. We're talking 15,000 contracts of a short call spread. Now, the thesis here, and this is key, isn't that ASHR is going to go down. No, it's a bet that it will stay below a certain price. The goal is simply to sell that overpriced volatility we just talked about and let the options expire worthless so they can pocket the premium. We spot these kinds of plays by tracking something called options flow. It's basically the real-time fire hose of all the large orders hitting the market. Analyzing this flow gives us a direct window, a peek behind the curtain, into institutional positioning. It's one of the clearest signals for seeing where the big money is actually placing its bets. And this slide right here, this absolutely nails the core difference in mindset. The retail trader asks, is it going up or down? It's a 50-50 guess, right? The institution asks, how can we structure a trade to profit from this overpriced volatility while defining our risk? You see the difference? It's a complete shift from fortune-telling to actual strategy.
So, what's the bottom line here? All of this data gives us a data-dependent, asymmetric outlook. It's not about being a bull or a bear. It's about being an opportunist, ready to act based on the evidence in front of you. Now, let's be objective. The bull case is pretty clear. Tracking institutional flow and these volatility anomalies can give you a very real edge, but you have to look at the bear case too. This data, it's not a crystal ball. Institutions can be wrong, and they can unwind these massive positions in a huge hurry. The data is a snapshot in time, not a guarantee for the future.
So after all of that, after all this data on rotation, volatility, institutional flow, what is the critical takeaway? What's the one thing you really need to remember from all of this?
Here it is. Your edge is not about predicting the future. It's about building a repeatable process. It's about using objective data to find high probability setups, and then always, and I mean always, managing your risk. That is how you find the signal in the noise.
So that's our analysis. Whatever you decide to do out there in these markets, just remember two things: stay disciplined and stay liquid.
And just a reminder, this analysis is for educational purposes only, and it's based on data from December 3rd, 2025. This data changes, and it changes rapidly. This is not financial advice, so please be sure to conduct your own due diligence before making any investment decisions. We are tracking these flows in real time. So while you analyze the next move, go ahead and check out the tools in the description. You can sign up for Public to get $20 in free assets, check Rebull for that BTC promo, or look into NVDA on Moomoo. All the links are down below, and hey, like and subscribe for more deep dive analysis.